welcome back to our series of videos, and as promised, this one discusses the upcoming Jackson Hole meeting that we are going to be looking at and seeing in terms of tomorrow afternoon. Now, as yet, details are not particularly clear as to how this is going to get released. My understanding and memory of this is that we get a text version, a little bit like her Capitol Hill testimony. We get a text version of this that's released at 3 o'clock UK time via your news provider, and then she speaks afterwards at 4. It would be very unusual were she just to speak and there would be no text version, but we need to really pay attention and make sure we understand how and when this gets released tomorrow afternoon, as this was filmed on a Thursday, tomorrow afternoon being the Friday. Now, what I want to do is take you back a couple of weeks to the last time that we sort of heard the chatter sort of intensified with regard to the Fed members, and also we'll discuss the Fed minutes, and we'll go through, I think we'll pay particular attention to the bunds and the 10 years in terms of our bond markets, the cable and the euro in terms of our FX, and of course the S&P as well for the US participants. And we'll go through all of these markets and we'll sort of tell the story as to what developed. But I think before we do that, going forward, we need to understand the path that is being trod at the minute and what is likely or unlikely to be mentioned. And I think the problem that we got is we have a real lack of clarity within the market at the moment, and a disbelief as to whether the Fed are going to react. And for me, that's why we really do have to understand that this is the chance. This is Mrs. Yellen's chance to really clarify what their intent is coming into September. And it's important as well because I think this gives her a chance to gauge the market reaction. And for anyone that says the Fed does not watch the markets, they are lying. Since 2008, the Fed, and before I'm sure, but specifically since 2008, the Fed have been monitoring the markets. They have put a plunge protection team in place. Anytime the S&P drops 10%, something somewhere miraculously happens that bolsters and reinvigorates the S&P in particular. So they do pay attention to the markets. So for me, this is a perfect opportunity to actually set policy without setting policy. They can gauge the market's reaction to an aggressive hawkish stance or maybe a dovish stance, and that's really, for me, how I view this meeting going forward. Now, if you look at the build up to this is the chart of the Bund. Now, cast your mind back to the 16th of August. I remember this trade particularly well, and actually I'll show you on a market profile why I remember this trade particularly well, because of the way we went into it, and the timing of it was quite unreal. So it was back across on this day that we'd built one of our crazy ledges just in front of the open. So the whole day we'd opened at 65, we had our IB low at 63, and then we obviously popped up higher throughout the day, leaving a bad high. And we ended up leaving a sort of 4 or 5 TPO ledge at 66 on this day, and then the market eventually broke lower, and it was a real trigger point. Nothing was said. This wasn't a Fed speaker on this day, but the market started aggressively breaking lower, and we moved all the way down to 167.17. But it was this day where we actually got a couple of Fed speakers come out and be particularly hawkish. And the reason I remember it so clearly is because I was obviously offered up here at 63, 64. And we'd spent the whole day balancing this area, and I was looking for this sell pretty much for the whole day. It was the only trade that I was looking for. And the timing of Dudley coming out was such that I actually obviously never got my offer. And then on the Z prints, we ran the whole entire length, if you can see, of the day's balance, all the way down to these single prints in about 10 minutes. And the statement that he came out with was that the Fed, and him in particular, was obviously looking to raise rates. September was still on the cards, and that was then further emphasised by, I believe it was Lockhart coming out the next day, and that day as well, about an hour later, saying that maybe one or two rate rises were on the cards for the end of this year. And the bond markets took this seriously. And you can see the bond market's absolutely collapsed. You'll see a replication of this in the 10-year when we go to the 10-year. They absolutely, just tanked on what was a pretty quiet day. And we actually got all the way down to this high volume area here. So we ran quite a lot of the range. This was quite a big move, considering that our overall range has been about a point and a half, 130 ticks. And on this day alone, we'd done a point of it. So this was quite an aggressive move, and the market did take this quite seriously. However, the next day, we had the Fed minutes come out. And those Fed minutes told a bit of a different story. And they started talking about the data not fully being there. There was still worries that inflation was too low. They acknowledged the job markets were fine, but there was just a worry that there wasn't enough data on this, and the market took this back as being particularly dovish. And not only that, someone came out and said that, quite frankly, the timing of a rate hike is not that important, because they feel that inflation started to move higher. They would have plenty of time to adjust policy to keep inflation in check. And actually, it's not the first time that inflation has been a particular buzzword, because we have heard other Fed voters come out and say that perhaps it's time to move away from their jobs target and their unemployment target, and move much more aggressively towards an inflation target, and actually start linking it to an inflation target as opposed to the jobs target that they have. And obviously, the Fed, they're pretty much, this 2% is pretty much what people are looking for when it comes to inflation targets. And of course, we are some way off of that at the moment. So, that's really, the Fed minutes highlighted that. And of course, we clawed back all of the losses that we had over the course of these days. And so we got this market that was saying pretty hawkish things to Fed minutes that were saying pretty dovish things. And since then, we have obviously maintained ourselves and sat somewhere in the middle. Now, just to sort of show you and replicate that as well on the 10-year, this is what the 10-year did over those 2 days. So you can see that we had opened, and again we had moved higher over the afternoon, dragging the Bund with us up to that magic level of 61, 62. But then as soon as the market came out and said what it said, this was what the 10-year did. So the 10-year did take it in the same tone as the Bunds and dragged itself lower. And of course then we re-established ourselves on the Fed minutes day by coming back up, and you can see that since then really we've had a succession of range days that pretty much encapsulate the first initial move. So again, we haven't moved a great deal. Yesterday we tightened up even further. So the bond markets did take it quite in the tone in which it was meant. However, this is what's interesting about the markets, is that if you look at the euro on that day, on the 16th, the euro didn't believe it at all. And this is where I think things get a little bit interesting. This is euro strength. Okay, so this is the euro going up. This is dollar weakness. Actually, not only is it dollar weakness, but it's aggressive dollar weakness with a range above and beyond what we had seen for, pretty much since the end of last month, on a day that the dollar should strengthen, and it didn't. And the euro, it did back off a little bit, because as we came into the day, and if we scroll back, as we came into that day on the 16th, you can see that we had already moved sufficiently higher. So this is the 16th here, and we were embarking on a trend day, and we had moved, by the time the speech came out, again it was on those Z prints, remember, we were all the way up here at 133.75. But were the dollar to have believed what had been said, we would not have held here. This is only a handful of ticks really from its high, 30 or 40 ticks. And so the euro maintained its strength, the dollar maintained most of its weakness, and of course after the Fed minutes we carried on. But whereas the bonds actually believed what the market was saying and what the Fed voters had actually said, whereas the bonds had believed it, the currencies really didn't. And the same goes for the cable. So if you look at the cable on this day, this is a market that fundamentally should be weak. Again, this is where the bounce actually started. Big up day for the cable, and it didn't even retrace. I mean, our high is up here at 130.54 and we closed at 130.40. We did not retrace hardly any of the move at all on the day of the 16th. So if I show you the market profile, yes, it was, obviously less of a trend day than the euro, but when the market came out on those Z prints, the Z prints are down here. Okay, so the high at the time was 129.67. And pushed up to 130.19. This was when the market came out and actually heard the commentary from Dudley and Lockhart, and yet we finished the day higher. So we finished the day higher than when that statement was announced. That showed some real dollar weakness, and it showed a complete disbelief as to the fact that the Fed were going to, or likely to, raise rates. And the S&P was the same. So the S&P has been locked in a pretty dreadful range. I think we all know and accept this. But this was the day. This was the day when that we were talking about, and nothing. Barely a reaction. We opened at 81.5. We closed 4 handles lower. Hardly a reaction that you would expect from a market that is meant to be in relative fear of rate rises. And since 08-09, obviously we've been hooked on QE, and any time things get a bit shaky, the Bank of England had proved this with their panic over Brexit. Any time things look a bit shaky, we run to the printing press and we start sort of printing money. And so this really isn't. 3 of the 5 markets that we've looked at have not reacted the way in which we thought, and there is a complete disbelief out of those 3 markets that the Fed are going to raise rates. Obviously the bonds did believe it and moved on the news, but were ultimately proved wrong because the Fed minutes brought us all the way back up here. And since then we have had a little bit of extra chatter. As I sort of posted in the blog that I did, there has been a small amount of extra chatter in terms of adjusting and moving the benchmark, so that we talk about, it was Feds Williams that was talking about central banks needing to develop new tools, tinker with maybe higher inflation targets or higher GDP targets, and sort of move away from the jobless and the non-farm side of things, the jobs side of things, which we've been particularly focused on. So you've got this situation at the moment where there's a distinct lack of a belief that the Fed are going to raise rates, backed by the Fed minutes and backed by some commentary that we've seen recently in terms of these new tools and higher inflation targets. So that's your particularly dovish stance. But you've also got the other side where people are thinking, well, maybe, we're still unsure. Are they going to raise rates in September? Are they, going to be in December? December is very 50-50. September, you're talking a very sort of low percentage. You're expecting a rate move, 18% against 82. Are expecting rates to not move in September. And of course, November is no better. But December, people are very 50-50 as to whether rates are going to move. So for me, this is a real opportunity for Yellen and for the Fed in general to get across the real message that they want to get across, and it has to be unambiguous. If you get ambiguity, for heaven's sake, get off your trading screen, because this market is just going to chop you to death. We're in an awful area and an awful set of ranges where the market will absolutely kill you. I've spoken and put some stuff out this morning about this Eurostoxx. We are just in the middle of last week's value, just getting killed. Again, we had a move all the way down to areas that we didn't anticipate would go in a straight line. We're back down to new lows. It's a very, very difficult area, and if we maintain that ambiguity in the market, it's going to be hell to trade. But I think and I hope that Mrs. Yellen really wants to make sure she gets her message across. And there is part of me that thinks she might test the waters of hawkishness. Let's not forget she can change her mind. So if the markets really dislike this, and the S&P, heaven forbid the S&P sold for a day, but were it to sell for a day and 10% lower, or maybe even drag us down to these lofty areas still of 2083, she's still got the ability to change her mind. And let's not forget that credibility is not really as much of an issue as it used to be. I think the ECB have proved us on that point. I think the Bank of England have done a fantastic job of proving that point. So I don't worry so much about credibility. If she sets out a bit of hawkish tone and the market plummets, she's testing the waters. And make no mistake, she can change her mind come September and say that the data doesn't warrant it, or the S&P's in turmoil, or Brexit. Blame the UK again. So there's plenty, in my mind, there's plenty of scope for her to test the waters on the hawkish front, and do so without ambiguity. And I will definitely be looking for that. And of course, you want to be looking, in terms of a general, a general sell-off in bonds, obviously, a sell-off in the Bund to follow suit, a sell-off in the S&P, and you'd be looking for that dollar strength. So you'll see a fairly big retracement in terms of the cable and the euro, because we're on an upward trajectory at the minute. So if she delivers that hawkish message, that's what you want to be looking for. However, there is the flip side, and she can deliver a super dovish message. And that dovish message would seem to be, and would seem to indicate, that it's going to be maybe moving towards inflation targets, maybe moving away from the traditional measures that we're looking at, maybe just saying that we need a higher inflation target. Now all of these are super dovish messages, and super dovish messages means that the rates are going to move nowhere. You'll see it price even lower for September and November. You'll probably start to see it weigh in December, more across the, away from the 50-50, and of course that will have its inflections as well. You'll see the S&P rally even further. You'll see the cable and the euro rally, and you'll probably see I think the bunds will rally. Because of the interest rate side of things. I think that one is particularly difficult because it changes the inflation barometer, and bonds don't like high inflation. And so if they change the benchmark of needing something higher than 2% inflation, then that's going to weigh on the bonds mind a little bit. So yes, it should knee-jerk higher, but I can also see a reason for staying out of the bonds, because that higher inflation, once it starts to get away from you, is going to eventually lead to an excessive shooting of rate hikes at some point. And don't forget, we trade a 10-year bond market. So I think the dovish message is trickier in the bonds. I think if you get the dovish message that we're looking for, your FX markets, your equity markets are the place for you to sit. I think if we get that hawkish message, I certainly think the bonds and the S&P and the currencies, all of those are the place to sit and reside. But they're my thoughts. That's what I'm looking for. How it's delivered, I don't know. I desperately hope it's unambiguous. I think we all hope it's unambiguous, because we really do need a bit of clarity from the Fed. I think that's what the market is crying out for. I think she will understand this, and I'm hoping that we get that unambiguous message. Unfortunately, if we don't, it's going to be hands off the mouse, enjoy the weekend, enjoy the bank holiday weekend, and come back and get back onto the technicals and wait for things to be a little less, foggy than they otherwise would be. So I hope that all makes sense. Obviously, I am going to post this video on our website. I will send a couple of links out on Twitter and Facebook, but it is, for those of you that are subscribing, it is only for subscription coming into Jackson Hole. I will release it for public consumption after the event, just to keep our channel looking fresh and let people know what they're missing out on. But I hope that makes sense. Please do watch it beforehand. If you've got any questions, please feel free to get in touch with me. Facebook, Twitter, Skype, whatever suits you. But other than that, I hope that you have got a little bit more clarity around what is expected and how the markets have reacted of late. And I hope that trading goes super, super well for you. I will speak to you another time.